What did the Fed actually say in its last meeting on June 19th? The things the Fed did say is that downside risks to the economy are diminishing. The Fed did acknowledge that the economy is gaining jobs, it is continuing to grow, and that there are lower chances that the US will fall into a recession. This is good news and important news. Another thing is, in an effort to clarify and to provide more transparency to the market, the Fed added another goal, which is an unemployment rate of 7%. Of course, it's tentative, but it's not. But it's a forward guidance, which is important. And when unemployment will reach 7%, QE will stop. This adds to the previous goal of 6.5%, when the unemployment will reach 6.5%, and as long as inflation remains contained, the Fed will keep rates low. Okay, so, and then Ben Bernanke went into the press conference, into the press room, and talked about tapering QE in late 2013 and potentially ending it in mid-2014. These are, of course, conditional measures. So, let's see what the Fed didn't say and why the Fed was cautiously optimistic and didn't commit itself to tapering QE. Or just before that, a quick talk why it is important for those of you who don't know. The quantitative easing program is a program where the Federal Reserve buys bonds in the open market. The general idea is to keep long-term rates relatively low, so that people will be encouraged and businesses will be encouraged to borrow money and spend it and stimulate the economy. It started one program back in 2009. It was over $1 trillion. After the program ended, there was fear of deflation, and the Fed began QE2 at the end of 2010, which was a limited program for $600 billion and 8 months. After this ended, the Fed moved on to QE3, which is already an unlimited program. The Fed buys monthly in the quantity of $85 billion of bonds every month, without a target, without an end date or a final quantity. And buying more bonds means printing more dollars, and this means a lower value of the US dollar. Stopping the program or even tapering QE strengthened the dollar. But it's important to remember that also tapering QE means that the Federal Reserve is still expanding its balance sheet, and that actually more dollars are printed. But change in expectations in the number of in the amount of bonds that it buys already has an impact on the dollar. So it's important to remember that even this tapering decision, which, as I just mentioned, isn't a decision to tighten monetary policy, is still data dependent. This message didn't pass very well. After June 19th, quite a few officials in the Federal Reserve made an effort to say that this message didn't pass really well, and it's data dependent. Everything depends on the data, and there's no commitment to stop the QE program or to taper it down. Another thing I have to notice is that the Fed is optimistic about growth. The Fed left very high growth expectations of 2.3 to 2.6%. It did lower them, but these expectations are still high. Q1 growth was revised downwards just recently to 1.8%, and Q2 is expected to be slower. If we've seen now the trade balance figures that were released a few hours ago, it showed a higher deficit, and it adds to the expectations that the GDP will be lower, even slower than 1.8 on an annual basis. So growth in the third and fourth quarters needs to be above 3%. This is quite a challenge, especially with the political environment. We'll talk about that also. We have the target for stopping the QE program altogether is an unemployment rate of 7%. Current unemployment rate is 7.6%, so it's only 0.6% to go. But it's not that easy and not that close. The participation rate is still around the lows seen in 1979. That means less people participate in the workforce, and that's another reason that the unemployment rate is relatively low. And what happens when the economy improves is that more people join the workforce and look for a job. They're encouraged. So even if we get a big rise in jobs, we'll still have a high unemployment rate as the participation rate goes up. Is that the U.S. is undergoing a sequester. What is the sequester? Originally, it was just a threat to force politicians to reach a deal after the U.S. presidential elections in 2012. And Obama was re-elected, and Congress is still in the hands of the Republicans, so basically nothing really changed in American politics. So this threat to make automatic cuts actually went through. So the government cuts are clearly hurting jobs. We were seeing in most months we were seeing less jobs from the government, and jobs are growing despite this, thanks to growth in private jobs. And another thing is the sequester does work in terms of burning less cash. That means, contrary to austerity here in Europe, making cuts actually lowers the deficit and doesn't lower also the tax revenue. So with the debt ceiling moving a bit further away, with less pressure to cut to reach a deal on long-term spending, politicians are really taking their time, also around the sequester. So what happens now is the Fed wants and clearly said that the government will change its policy, will make less cuts in the short term and maybe more cuts in the long term, but the government isn't going to move too much. So that's another weight on growth and what makes the Fed too optimistic. Okay, so after Ben Bernanke's press conference, headlines came out that the Fed will probably taper in September. It might happen also in October, depending on the data, and QE in the middle of 2014. And perhaps starting raising interest rates in 2015. It's important to remember that this is still an accommodative policy, still loose monetary policy, and as I just mentioned, the expectations are quite optimistic.